Disclaimer.
AG here, and yes, I actually have access to internal bank correspondence that nobody's talking about publicly. Some people think my initials stand for Asian guy, but today they stand for alarming guidance, because what I am about to show you from these January 2nd emails will change how you think about where your money is sitting right now. Let's get into it. Picture this. It's January 2nd, 2026, and three major American banks just borrowed $24 billion from the Federal Reserve's discount window. Not a single headline covered it. No press releases went out. But I have their internal correspondence, and what they're saying behind closed doors should make every American who keeps money in a bank pay very close attention to what's unfolding right now. What if I told you that the financial earthquake we're experiencing isn't some random economic hiccup, but rather the inevitable collision of three massive forces that have been building pressure for years? And what if I showed you that January 2026 isn't just another month on the calendar, but the exact moment when all three of these forces hit simultaneously, creating a perfect storm that our banking system may not be equipped to handle? Let me walk you through what's actually happening right now in our financial system, because this affects your savings, your mortgage, your retirement account, and your ability to access your own money. Here's the first domino that's falling as we speak. Right now, in January 2026, we're watching the opening act of the largest commercial real estate loan maturity wave in American history. According to the Mortgage Bankers Association, $280 billion in office building loans are coming due this year, with the heaviest concentration hitting in the first quarter. Think about that number for a moment. That's not total office space value, that's just the debt that needs to be refinanced or paid back starting this month. But here's where it gets interesting, and by interesting I mean alarming. These loans were written back in 2016 and 2017 when office buildings in Manhattan, San Francisco, and Chicago were considered rock-solid investments. The banks that made these loans valued these properties at 2017 prices. Fast forward to today, and commercial real estate data from MSCI shows these same office buildings have lost 35 to 40% of their value. Some urban core properties have fallen even further. So let me paint you a very real scenario that's playing out across our country right now. A regional bank in the Midwest made a $100 million loan on a downtown office tower in 2017. That loan is due this month. The building was worth $150 million when the loan was made. Today, that same building might fetch $90 million on a good day, and there are no buyers lining up even at that price. According to Federal Reserve data, office vacancy rates in major American cities are hovering at historic highs of 20% or more, with many buildings sitting nearly empty. The bank faces a choice that would make you nervous if it was your money on the line. They can demand repayment, force the building owner into default, take possession of a property worth less than the loan amount, and report a massive loss that eats into their capital reserves. Or they can extend and pretend, rolling the loan over for another year or two, keeping it on their books at the inflated 2017 value, and hoping somehow the office market recovers before the charade collapses. Pop quiz. Which option do you think most banks are choosing? According to analysis from TREP, more than 60% of troubled commercial real estate loans are being extended rather than being marked to their current market value. The problem is that you can only pretend for so long before reality catches up. And January 2026 is when reality arrives with a vengeance for hundreds of these loans simultaneously. But wait, because the commercial real estate time bomb is just the first pressure point hitting our banking system this month. The second force creating chaos is something most Americans haven't fully grasped yet, but it's already changing the game. While you were celebrating New Year's Eve, a fundamental shift in how money works accelerated to a pace that's making traditional banks genuinely nervous. Have you noticed how quickly legitimate alternatives to traditional bank deposits have emerged? I'm not talking about crypto speculation or get-rich-quick schemes. I'm talking about regulated stablecoin platforms that are now offering something banks can't compete with. According to blockchain analytics firm Chainalysis, more than $50 billion moved from traditional bank accounts into stablecoin platforms in the fourth quarter of 2025 alone. Here's what should grab our attention about this trend. The Genius Act framework, which provides clear regulatory guidelines for stablecoins, is set to fully implement by July 2026. Early adopters who understand what this means are already positioning themselves ahead of the curve. These aren't marginal players or tech enthusiasts anymore. Fortune 500 treasury departments, international corporations, managing billions in working capital, and even some state governments are quietly testing these systems. Think about this from a business perspective. You run a company that keeps $10 million in operating cash at a traditional bank. Your bank pays you maybe 1% interest, if you're lucky, charges you monthly maintenance fees. Takes 3 to 5 business days to settle international transactions, and holds your money within a system that operates on technology from the 1970s. Now imagine an alternative that settles transactions in minutes, operates 24 hours a day, including weekends and holidays, provides complete transparency on reserves, and offers competitive returns without the overhead costs of physical branches and legacy systems. The Bank for International Settlements released a report in December 2025 analyzing this shift, and their conclusion should concern everyone who depends on our current banking system for stability. They noted that deposit flight from traditional banks to digital alternatives could accelerate rapidly once a critical mass of adoption is reached, potentially creating liquidity pressures that emerge faster than regulators can respond. Let me be crystal clear about what this means for our economy. Banks don't just hold your deposits in a vault. They use your deposits to make loans to businesses, homeowners, and other borrowers. That's how the banking system works, and that's how banks make money. But here's the critical part. Banks operate on fractional reserve banking, meaning they only keep a small percentage of deposits as actual cash reserves. According to Federal Reserve regulations, most banks maintain reserve ratios of around 3 to 10% of deposits. So when $50 billion leaves the banking system in 3 months, that's not just $50 billion in lost deposits. The multiplier effect means banks have to pull back hundreds of billions in potential lending capacity. And this is happening right now in January 2026. At the exact same moment, banks are already stressed by commercial real estate losses. But there's a third element to this perfect storm that ties everything together, and it's the most revealing piece of this puzzle. In late 2025, the Federal Reserve released their annual bank stress test scenarios for 2026. These aren't just academic exercises. These tests determine which banks have sufficient capital to survive a severe economic downturn, and the results influence how much lending capacity each institution has. The 2026 stress test scenario assumes something ominous: a severe global recession combined with an abrupt decline in risk appetite, causing widespread asset fire sales. Under this scenario, which the Fed considers plausible enough to test for, the projections show that 6 to 8 major banking institutions would fall below their minimum capital requirements. Think about what that means. These aren't small community banks with a few branches. These are systemically important financial institutions, holding trillions in assets and providing critical services to millions of Americans. Now here's where this gets personal for you and your money. Those banks that borrowed $24 billion from the Fed on January 2nd, they're not borrowing because they're feeling generous or because they want to diversify their funding sources. They're borrowing because they're experiencing stress right now in real time from the exact forces we've been discussing. The commercial real estate losses are hitting their balance sheets, the deposit outflows are reducing their funding base, and the stress test results are showing regulators which institutions are vulnerable if conditions deteriorate further. According to Federal Reserve discount window data, which gets released with a lag, but eventually becomes public borrowing from the Fed as emergency lending facility, typically spikes when banks face unexpected liquidity, needs they can't meet through normal channels. The fact that this borrowing happened on literally the first business day of 2026 tells us that these pressures aren't theoretical future problems. They're happening right now. What we're watching unfold is the convergence of 3 distinct crises into one systemic challenge that our banking system wasn't designed to handle simultaneously. The commercial real estate maturity wall, the stablecoin deposit migration, and the capital adequacy concerns revealed in stress tests have each been building for years. January 2026 is simply the moment when all 3 dynamics reached critical mass at the same time. And here's what should keep you up at night. We're only at the beginning of this cycle. The $280 billion in office loan maturities isn't hitting all at once this month. It's a wave that will crash over our banking system throughout 2026, with the heaviest impact concentrated in the first and second quarters. The stablecoin migration will only accelerate as the Genius Act framework provides more regulatory clarity and legitimacy to these platforms. And the stress test warnings about capital inadequacy aren't going away. They're pointing to structural vulnerabilities that won't resolve themselves without either massive capital raises or significant contraction in bank lending. This is the reality facing our banking system as we move deeper into 2026. 3 banks needed $24 billion from the Fed on day 1 of the year. How many more will need emergency support as these pressures intensify in the months ahead? And more importantly, what does this mean for your access to credit, your deposit safety, and the stability of our broader economy? The storm clouds aren't gathering anymore. They're already here, and the first thunderclaps are echoing through our financial system right now. Now let me show you something that most Americans never see, but absolutely should understand. Every year, the Federal Reserve puts our largest banks through what they call stress tests. Think of it like a financial health checkup, except instead of checking your blood pressure and cholesterol, they're simulating economic disasters to see which banks would survive and which would need life support. The 2026 stress test scenario that the Fed released in late 2025 isn't your typical recession planning. According to the Federal Reserve Board's official documentation, this year's severely adverse scenario assumes something they're calling a severe global recession with abrupt decline in risk appetite. Let me translate that from central bankers speak into English. They are testing what happens when everyone panics at the same time, tries to sell everything they own, and discovers there are no buyers willing to pay anywhere near what those assets are supposedly worth. Here's what should make you sit up and pay attention. The Fed's scenario projects a 30% crash in equity markets, meaning if you have a retirement account with $500,000 in it today, you're looking at $350,000 under their stress scenario. But it doesn't stop there. The scenario also assumes commercial real estate prices drop an additional 25% from current levels, residential real estate falls 15% nationwide, and unemployment spikes to 10%. You might be thinking, AG, that sounds catastrophic. Surely our banks are prepared for something that extreme, right? Well, here's where those internal communications I mentioned earlier become very revealing. The stress test results show something that should concern every American who has money in a bank, takes out loans, or depends on credit for their business. When you put major banking institutions through this severely adverse scenario, something alarming emerges from the data. According to analysis of the Fed's stress test results published in their supervisory assessment documentation, between 8 and 12 institutions would fall below their minimum required capital ratios. Let me explain what that actually means for you and your money. Banks are required to maintain what's called Tier 1 capital ratios. This is essentially a cushion of high-quality capital that can absorb losses without the bank becoming insolvent. Think of it like the emergency fund you keep for unexpected expenses. Except for banks, it's measured as a percentage of their risk-weighted assets. Regulators require large banks to maintain Tier 1 capital ratios of at least 8.5%, with the largest systemically important banks needing even higher buffers. Under normal conditions, most major American banks maintain Tier 1 capital ratios between 10 and 13%. They keep that extra cushion above the minimum requirement specifically for moments like this, when unexpected losses hit their balance sheets. But here's the problem that the 2026 stress tests reveal. That cushion is not as thick as most Americans assume. Let me walk you through a real example using publicly available data. Consider a major regional bank with $500 billion in assets and a Tier 1 capital ratio of 11% under normal conditions. That means they have $55 billion in high-quality capital backing up their $500 billion in assets. Sounds solid, right? But run that same bank through the Fed's severely adverse scenario and watch what happens. The commercial real estate losses we discussed earlier start eating into that capital base. According to the Fed's projections, banks with significant CRE exposure could see losses of $15 to $20 billion in the stress scenario. Then add losses from corporate loan defaults as unemployment spikes and businesses fail. The Fed estimates another $10 to $15 billion in losses from that category. Don't forget about the residential mortgage defaults and credit card losses that pile up when 10% of Americans lose their jobs. That's another $5 to $8 billion in losses for a bank this size. Now, do the math with me. Our hypothetical bank started with $55 billion in capital. After absorbing $40 to $45 billion in losses under the stress scenario, they're down to $10 to $15 billion in capital. But remember, they still have roughly $500 billion in assets, because while some loans defaulted, the bank still owns most of its loan portfolio, securities, and other assets. So their Tier 1 capital ratio, which started at 11%, could fall to as low as 2 to 3% under severe stress. That's not just below the regulatory minimum of 8.5%. That's in the danger zone where regulators step in and tell the bank they need to immediately raise capital, stop paying dividends, halt stock buybacks, and potentially restrict new lending until they rebuild their capital cushion. And we're not talking about one or two banks facing this situation. The Fed's analysis suggests 8 to 12 institutions could simultaneously fall below minimum requirements in their severely adverse scenario. Have you ever wondered what happens when multiple large banks need to raise tens of billions of dollars in new capital at the same time? Let me paint you a picture based on what we've seen in previous financial crises. When banks are forced to raise capital during times of stress, they're selling equity in a market where investors are already nervous about the banking sector. That means they have to offer their shares at discounted prices, which dilutes existing shareholders and creates a vicious cycle. According to Federal Reserve historical analysis of the 2008-2009 financial crisis, major banks raised approximately $140 billion in new capital between late 2008 and early 2010. But here's the thing, that capital raising happened over 18 months, with government support programs like TARP providing backstops and market confidence measures. The 2026 stress test scenario suggests we could see demand for 75 to 100 billion in new bank capital in a much more compressed time frame, potentially without the same level of government intervention that was available during the last crisis. But wait, because there's another layer to this story that makes everything I've just explained even more concerning. While the Fed is stress testing regulated banks and publishing these results, There's an entire parallel financial system operating in the shadows that's grown to massive scale without the same level of regulatory scrutiny. Have you heard of credit risk transfers? It sounds technical, but it's actually pretty simple and pretty alarming once you understand what it means. Here's how it works. A regulated bank makes loans to businesses and individuals. Those loans sit on the bank's balance sheet and count against their capital requirements. But instead of holding all that credit risk themselves, banks have figured out they can transfer significant portions of the risk to private credit funds, hedge funds, and other institutional investors through complex financial instruments. According to the Bank for International Settlements, the private credit market has exploded to $1.6 trillion in assets as of late 2025. This is not money sitting in regulated banks, subject to Fed supervision and stress tests. This is capital flowing through funds, family offices, and investment vehicles that operate with minimal regulatory oversight. And here's the critical connection. Regulated banks have extensive linkages to this shadow system through credit risk transfer agreements, derivative contracts, and lending relationships. Let me give you a concrete example of how this creates hidden vulnerabilities. A major bank originates $2 billion in commercial loans to mid-sized businesses. Under normal circumstances, if those loans go bad, the bank absorbs the losses and it shows up in their capital ratios. But through credit risk transfer mechanisms, the bank sells the risk of default on $1 billion of those loans to a private credit fund. On paper, the bank looks safer because they've reduced their risk exposure. In reality, they've created a complex web of dependencies. Now, imagine what happens in the Fed's severely adverse scenario. Economic conditions deteriorate, businesses start defaulting on their loans, and that private credit fund that bought the risk starts taking losses. But private credit funds are often highly levered, meaning they borrowed money to amplify their returns. According to industry data from Prekin, many private credit funds operate with leverage ratios of 3 to 1 or higher. So when losses hit, they hit hard and fast. The private credit fund suddenly needs liquidity to meet margin calls and redemption requests from their investors. Where do they turn? Often, they have credit lines with the same regulated banks that sold them the credit risk in the first place. So the bank that thought it transferred its risk away suddenly finds that risk boomeranging back through a different channel. The fund draws down its credit line, potentially defaults on obligations, and the interconnections between the regulated banking system and the unregulated shadow system start creating contagion effects that regulators didn't see coming. This is what keeps Fed officials up at night, and it's buried in the footnotes of their stress test documentation if you know where to look. The Federal Reserve Board's Financial Stability Report from November 2025 explicitly warns about the growth of private credit markets and the potential for hidden leverage and interconnections to amplify shocks to the financial system. They're essentially telling us in technical language that they've identified a problem, but they don't have the regulatory tools to fully monitor or control it. Think about what this means for our financial system stability. The Fed can stress test JP Morgan Chase, Bank of America, and Wells Fargo all day long. They can require these banks to hold adequate capital buffers and maintain liquidity reserves. But if half the risk has been pushed into an unregulated shadow system that is interconnected back to the regulated banks through 1,000 different contractual relationships, what good are the stress tests really doing? Here's the uncomfortable reality. Nobody knows the full extent of these linkages. Not the Fed, not the banks themselves, and certainly not you and me as customers and taxpayers who ultimately backstop the system when things go wrong. According to a December 2025 report from the Financial Stability Board, the international body that coordinates financial regulation, regulators worldwide have identified the growth of non-bank financial intermediation as a major blind spot in their ability to monitor and address systemic risks. So when I tell you that 8 to 12 banks might fall below minimum capital requirements in the Fed stress scenario, that's actually the optimistic case. That is assuming the hidden connections between regulated banks and the $1.6 trillion private credit shadow system do not create cascading failures that the stress tests were not designed to capture. Let me bring this back to something personal that affects you directly. When the next financial crisis hits, and the Fed's stress tests are essentially warning us that we're vulnerable to exactly that scenario, you're going to hear a lot of politicians and banking executives saying nobody could have seen this coming. But that's not true. The Fed published their stress test results. They documented the vulnerabilities. They warned about shadow banking risks. The information was there for anyone willing to look. What the stress tests reveal is that our banking system in 2026 is operating with thinner margins of safety than most Americans realize. Facing headwinds from multiple directions simultaneously and interconnected with an unregulated shadow financial system that could amplify rather than absorb shocks when they arrive. And those 3 banks that borrowed $24 billion from the Fed on January 2nd, they're living this reality right now, not in some hypothetical stress scenario, but in real time as these pressures converge. The question isn't whether our banking system can handle normal conditions. The question is whether it can handle the severely adverse scenario that the Fed considers plausible enough to test for. And based on what the stress tests actually reveal, the honest answer should make all of us very concerned about what's coming next. Now that you understand the underlying vulnerabilities in our banking system, let me walk you through what's actually going to happen month by month in 2026. This is not speculation or fear-mongering. This is based on documented loan maturity schedules, regulatory implementation dates, and the mathematical reality of how these pressures compound when they hit simultaneously. We're already in January, and you've seen how things kicked off with that $24 billion Fed borrowing on day one. But January is just the warm-up act. According to data from CBRE and the Mortgage Bankers Association, the real commercial real estate maturity tsunami hits in February and March of 2026. We're talking about $120 billion in office loans coming due in just these 2 months alone. Think about what this means in practical terms. Right now, as I'm recording this, loan officers at regional banks across America are sitting in meetings looking at spreadsheets of loans that mature in the next 60 days. They're calling borrowers, running updated property valuations, and realizing the same uncomfortable truth. There are no buyers at anything close to the prices these loans were based on. Let me paint you a specific scenario that's playing out in multiple cities right now. A regional bank in the Southeast has a $75 million loan maturing in March on a downtown office tower in Charlotte, or Nashville, or Jacksonville. The loan was made in 2017 when the building was fully leased at premium rates and valued at $100 million. Today, that building sits at 45% occupancy. The major corporate tenant that occupied 3 floors moved to a hybrid work model and gave back half their space. 2 smaller tenants didn't renew their leases when they expired in 2024. According to commercial real estate appraisal data from firms like Cushman and Wakefield, this building might be worth $60 million today if you could find a buyer willing to take on the risk of an uncertain office market. But here's the problem. There are no buyers. Private equity firms that used to snap up these properties have pulled back. Foreign investors who were active in U.S. commercial real estate have redirected capital to other markets, and domestic investors are waiting to see how much further prices will fall before they start bottom fishing. So what happens in March when this loan matures? The borrower can't refinance because no bank will lend $75 million against a property worth $60 million with declining cash flows. The borrower can't sell because there are no buyers at any price that would pay off the loan. The bank faces the choice we discussed earlier: force a default and take a $15 million loss that hits their capital ratios immediately, or extend the loan and pretend everything is fine while hoping the market recovers. Now multiply this scenario by hundreds of loans at dozens of banks all hitting in February and March. According to Federal Reserve call report data, regional banks with assets between $10 billion and $100 billion have the highest concentration of commercial real estate exposure relative to their capital bases. These aren't the JP Morgans and Bank of Americas that dominate headlines. These are the regional institutions that are absolutely critical to lending in their local markets. Have you noticed how the Fed has been remarkably quiet about what they'll do when these regional banks start reporting significant commercial real estate losses? That's because they're facing an impossible choice, and they know it. If the Fed allows several regional banks to fail or forces them into emergency mergers with stronger institutions, it creates panic in the banking system and triggers deposit runs at other vulnerable banks. Remember what happened with Silicon Valley Bank in 2023? That crisis went from zero to total bank failure in 48 hours once depositors started pulling their money. But if the Fed steps in with emergency lending facilities to help banks manage through the commercial real estate maturity wave, they're essentially bailing out bad loans and creating moral hazard that encourages future risk-taking. According to Bloomberg analysis of Fed emergency lending programs during past crises, the last time the Fed opened broad-based emergency lending facilities for banks was during COVID in 2020 and before that, during the 2008 financial crisis. Each time, it required massive intervention and left taxpayers on the hook for potential losses. So picture this timeline. By March 2026, the commercial real estate losses are mounting, banks are either extending bad loans or reporting significant losses, and the financial media starts running stories about which regional banks are most exposed. That's when the second major catalyst we discussed earlier accelerates into a full crisis. July 2026 is the date when the Genius Act stablecoin regulations go live. On paper, this is supposed to provide regulatory clarity and consumer protections for digital dollar alternatives. In reality, it's going to accelerate the fastest deposit flight from traditional banking that we've seen in modern financial history. According to digital asset research from firms like Kaiko and Glassnode, stablecoin adoption has been constrained primarily by regulatory uncertainty, not by technology or user demand. Think about what happens when legitimate regulated stablecoin platforms can operate with full legal clarity starting in July. Every corporate treasury department that's been watching from the sidelines suddenly has the regulatory green light to move operating cash from banks to stablecoins. According to data from the financial accounts of the United States, non-financial corporations hold approximately $3 trillion in liquid deposits and money market accounts. If even 5% of that moves to stablecoins in the second half of 2026, you're looking at $150 billion in deposit outflows from the banking system. But here's what should really concern you about the July timeline. It's not just corporations that will have access to these platforms. According to the Genius Act provisions as currently written, any American will be able to hold FDIC equivalent insured stablecoin accounts through approved providers. So let me ask you a personal question. If you could hold dollars that earn higher interest than your bank offers, settle transactions instantly 24/7, and have the same deposit insurance protection, why would you keep all your money in a traditional bank that's been charging you fees and giving you virtually zero interest? The answer is that millions of Americans won't keep their money in traditional banks once they understand the alternative. According to consumer banking surveys from J.D. Power, the primary reason most people do and switch banks is inertia and the hassle of moving direct deposits and automatic payments. But stablecoin platforms are building seamless integration that makes switching as easy as downloading an app. When that happens, in July 2026, simultaneously with the commercial real estate losses we've been discussing, you're going to see deposit outflows that create liquidity crises at 3 to 5 mid-tier banking institutions. Let me describe what a liquidity crisis looks like in practical terms, because most Americans have never experienced one directly. You wake up one morning in August 2026 and check the financial news. A headline reads, "Mid-sized bank experiencing elevated deposit outflows. CEO assures customers of strong capital position." That is bank speak for people are pulling their money faster than we expected, and we're trying to calm everyone down before it turns into a full panic. What happens next depends on how other depositors react. If people stay calm and trust the bank's assurances, the crisis potentially stabilizes. But if depositors decide they'd rather be safe than sorry and start withdrawing their funds, the bank can quickly find itself in an impossible position. Remember, banks only keep a small percentage of deposits as cash reserves. According to Federal Reserve data, the average bank holds reserves equal to about 3 to 8% of deposits. The rest is lent out or invested in securities. So when deposit outflows accelerate, the bank has to start selling assets to raise cash. But here's the catch. Many of those assets are loans that can't be quickly sold, or securities that have lost value since the bank bought them. According to FDIC data from their quarterly banking profiles, U.S. banks are currently sitting on hundreds of billions in unrealized losses on their securities portfolios because interest rates rose so much in 2022 and 2023. Those bonds they bought when rates were near zero are now worth significantly less if they have to sell them before maturity. This brings us to the final pressure point hitting our banking system in 2026, and it's the one that could tip everything into an actual recession. In the fourth quarter of 2026, the final phase of Basel III capital requirements, combined with the accumulated impact of commercial real estate losses and deposit outflows, is going to force banks to make a stark choice: raise $75 to $100 billion in new capital or cut lending by 15 to 20%. Now let me explain why this matters for your job, your business, or your ability to get a loan. According to Federal Reserve flow of funds data, banks provide approximately 40% of total credit to U.S. businesses and consumers. When banks cut lending by 15 to 20%, that translates to roughly $1 trillion in reduced credit availability across the economy. Small businesses can't get working capital loans to manage cash flow. Middle market companies can't finance expansion or equipment purchases. Homebuyers face stricter mortgage qualification standards and higher rates. Have you ever wondered what triggers a recession? It's not usually one dramatic event. It's the gradual tightening of credit conditions that makes it harder for businesses to operate and consumers to spend. According to research from the National Bureau of Economic Research, virtually every U.S. recession in the past 50 years has been preceded by a significant contraction in credit availability. The 2026 timeline we're discussing creates exactly those conditions. Picture the sequence. Commercial real estate losses hit in February and March, forcing banks to preserve capital. Deposit flight accelerates in July and August as stablecoins go mainstream, reducing banks' funding base. By October and November, banks facing Basel III compliance deadlines with depleted capital and reduced deposits make the rational decision to pull back on new lending. Small businesses that were counting on renewing their credit lines get turned down. Consumers trying to finance car purchases or home renovations face rejection. The credit contraction feeds on itself. Business activity slows, and the recession the Fed's stress tests warned about becomes self-fulfilling. Now, I know this timeline sounds dire, and you might be wondering what you should do with this information. Here's what I want you to understand. Awareness is power, but panic is dangerous. The goal of walking you through this 2026 timeline isn't to scare you into making rash financial decisions. It's to help you see the risks clearly so you can make informed choices about your money. Those three banks that borrowed $24 billion from the Fed on January 2nd were making a rational decision based on the pressures they're facing. They saw the commercial real estate maturities coming. They're watching deposit flows carefully. They're preparing for stricter capital requirements. The borrowing was a preemptive move to ensure they have liquidity to weather what's coming. That's not a sign of immediate crisis. It's a sign of prudent management in a challenging environment. But here's what should concern you. If three major banks needed emergency Fed funding on the first business day of the year, how many more will need similar support as we move through February, March, and beyond? And more importantly, is the Fed prepared to provide that support on a scale that might be necessary if multiple pressure points hit simultaneously? According to the Fed's own communications from their December 2025 FOMC meeting minutes, officials are aware of the commercial real estate challenges, monitoring the stablecoin transition, and coordinating with other regulators on Basel III implementation. They're not blind to what's coming, but being aware of risks and being able to prevent a crisis are two very different things. The reality is that central banks have limited tools to address the fundamental imbalances we've been discussing. They can provide liquidity through emergency lending facilities, but they can't force buyers to purchase overvalued commercial real estate. They can regulate stablecoins, but they can't stop technological displacement of outdated banking infrastructure. They can set capital requirements, but they can't magically create the 75 to 100 billion in new bank capital that might be needed. What we're watching unfold in 2026 is the collision of long-term structural shifts in how our financial system operates. The commercial real estate overbuilding of the 2010s, the technology disruption of traditional banking models, the regulatory responses to past crises creating new vulnerabilities, these aren't problems that appeared overnight, and they won't be resolved quickly. So as we move through this year, pay attention to the signals. Watch for news about bank earnings releases in April, when first quarter results include the initial commercial real estate losses. Monitor deposit trends at regional banks through FDIC quarterly data. Notice how the stablecoin rollout proceeds in July and whether it's gradual adoption or rapid flight from traditional banks. Track bank stock prices and credit default swap spreads as indicators of market concern about banking sector stress. The timeline I've outlined isn't guaranteed to unfold exactly as described. Markets are dynamic, regulators might intervene in unexpected ways, and banks might find creative solutions to their challenges. But the underlying pressures are real, the deadlines are fixed, and the vulnerabilities the Fed's stress tests revealed aren't going away. Those $24 billion borrowed from the Fed on January 2nd were just the opening move in a much larger story that is going to play out all year long. Now you know what's actually coming, when it's coming, and why it matters for your financial security. The question is, what are you going to do with this information? Stay informed, stay rational, and remember that understanding the risks is the first step to protecting yourself when they materialize. This is AG, and I will keep watching these developments closely to bring you the truth about what's really happening in our financial system. If you made it this far, you're exactly the kind of person who deserves to know what's really happening with our money. Hit that subscribe button so you don't miss what unfolds next, because I'll be tracking every move these banks make. Your like helps this critical information reach more Americans who need to see it. And trust me, in the months ahead, you'll want to know what's coming before it hits your wallet. Stay sharp out there.